Hey, what's up, everyone? Have you ever looked at financial statements and you don't have any clue as to how to analyze the financial statements? Where do you start? How do you form an opinion, etc.? Now, the purpose of this tutorial, and this is going to be one of in a series of four, hopefully, is to show you certain key ratios and how you determine whether the business is doing good or bad. What I've been doing over the years is I've been classifying ratios over four elements. One is performance, number two, working capital and liquidity, number three, gearing and risk, and number four, investor. So what I do is I normally calculate a couple of these ratios just to determine whether the company is good or bad. Of course, this will give us an idea. So looking at performance, one of the ratios we calculate is gross profit margin. And gross profit margin is calculated by taking the gross profit and divide by the sales or turnover figure. So let's look at a real company. So this is the financial statements for Unilever, and let's look at Unilever uh, 2018 figures. And if we want to calculate the gross profit, we take the gross profit figure. So there's my gross profit, 22,213. Of course, all it say is in millions of euros, but for simplicity, let's use the thousand figures. So 22,213 divided by 50,982. Now, what does that tell us? It comes to 44%. Is this good or is this bad? How I look at it is this. For every 100 euro of sales, so if you want, what does it mean? So remember, we got 44%. So my interpretation is this. For every 100 euros of sales, the company, in our case Unilever, the company achieves euro 44 of gross profit. Gross profit. Now, is this a good thing or is this a bad thing? Well, it depends on what the company directors have set for this company. Looking at it, it doesn't seem too bad. For each 100 euros of sales, I get 44 euros of gross profit. And of course, when you look at the financial statements, up to here, everything from turnover to gross profit relates to the trading activities, so purely trading activities. So, not too bad. I mean, a ratio on its own won't say anything. You have to analyze it for the different years and see whether it has gone up or down. But this is just a short video to illustrate how you analyze and what you make out of the ratios. The next ratio is operating profit margin. So for operating profit margin, what we do is this. We take the operating profits, so operating profits, and we divide by the sales figures or turnover figure. Let's look at Unilever's account. We got the operating profit margin. We got the operating profit figure. So that's this one here, 12,535. And if we divide that by sales figure, so in terms of percentage, that gives us 25%. What does that mean? Well, again, it means that for every 100 euro of sales, my operating profit is 25 euros. That's how you interpret. And of course, you can analyze between the different years and see whether it's gone up or down. But the idea is this. For every 100 euro of sales, this company, so Unilever, is making 25 euros of operating profit. The final ratio in performance is the return on capital employed. Now, what exactly is the return on capital employed? See, there are only two ways of financing a business. There are only two ways. There is either equity or debt. When we're talking about debt here, we're talking about long-term funds. So non-current liabilities. Those are the two ways that you actually finance a business. Now, when you've taken up the finance, you want to know, well, when you have invested in the business, so in the form of equity or debt, you want to know, well, if there's a combination of those two, what is the return that I'm generating? And of course, the return is the operating profits. The operating profits. That's the return that you're generating for the business, having contracted, having invested for equity or debt. Now, let's go and calculate the return on capital employed. For this, to get the amount of equity and debt, we need to look at the balance sheet figures. So let's look for that. So here's our balance sheet, or commonly known as statement of financial position nowadays. So total equity is equal 12. Of course, this is in millions of euros. 12,292. I want to add with this the total of non-current liabilities. So non-current liabilities. There you are. Now, what I want is this. Normally, I finance the business through financial liabilities, right? Because financial liabilities is things like loans, etc. This is how normally I would have financed the business. So, oops, hang on. So let's try that again. So equity 12,292 plus what is my financial liabilities? 21,6. So 21,650, 21,650. So this is how I would have the amount that I have invested in this business. So 33,942, of course, in millions of euros. And then my operating profit. So my operating profit, let's go look for that. So we're looking at 2018. Where's my operating profit figure? So hang on. Operating profit, there you are. Okay, 12,535. So 12,535. Let's go back to our financial statements. There you are. So what will be my return on capital employed? So it will be 12,535 divided by this figure here. So it gives me, so as a percentage, if you want, 37%. Now, what does that tell me? It tells me that based on the amount that we have invested in this business, so Unilever, the amount of equity and the amount of debt that we have invested in this business, I'm getting a profit or getting a return of 37%. There you go. Now, this is the end of the first series, and there will be a couple of series more to discuss about the other ratios.